What's up, y'all? It's Dr. David Roney. I hope everybody's doing well. Today is day 18 of 31 days in May and videos every day to change my habits and post more financial content. As always, you can find me on Twitter at Fisurgi, Fiusurgi, or Substack at surgified.substack.com or surgified.com. Now, let's talk about it, man. Exchange traded funds versus mutual funds. Okay. Back in the day, I remember the first time I really started to invest, my old coach, God rest his soul, caught wind that I was sort of doing, like, managing my money bad, right? I was spending way too much money compared to the money I got in. I got myself in credit card debt. Yeah. So he put me on an allotment. And he made me start investing early on, right? He opened up a Roth IRA because I had an income at that point. I might have been like 19 years old, 19, 20 years old. And he put basically $50 a month into a mutual fund. I had no clue what a mutual fund was. I didn't really understand the nuances of mutual funds probably till about 6-7 years ago, right? Mutual funds are an interesting thing. Like I grew up in college learning about mutual funds, had no clue what the differences are, but you can think of these things as just a wrapper, right? Think of it like grocery shopping, right? Whether you go to Kroger or you go to Publix or you go to Hy-Vee or whatever, right? Vons, a grocery bag, right? Think of those companies as think of a mutual fund as individual grocery stores, and in there you get a bag. And the items that you put in, that's the fund, right? So in some you get an index, in some you get concentrated exposure, meaning like very narrow companies that are picked, right? You have active versus passive type of funds, right? You have managers who manage the fund, so they get a management fee, right? And so traditionally over time, mutual funds were the standard. Like you go in, you put your money and you passively allow an active mutual fund manager to pick stocks, and what you're doing is you're trying to leverage their expertise to allow you to get a good return, right? And you're looking for exposures to different sectors, different parts of the stock market. You also have bond funds, but mutual funds are a way of sort of just packaging a number of securities together, so you get a exposure to a certain area. Now, exchange traded funds were like the new kid on the block, right? They're a way to do the mutual fund thing, but a more tax efficient thing. The thing about mutual funds is you pay into it and then it gets tallied up at the end of the day, so you don't get real-time pricing, so they have to make good at the end of the day. When people sell, it sort of affects everyone owning that mutual fund. Now, exchange traded funds are different. There's a reason why they're called exchange traded funds, right? Because you can literally trade them throughout the day. They're priced on and on throughout the day, so you get a real-time ability to trade them. So you don't have to worry about redemptions. They're more... There's a whole redeem and create mechanism. And I encourage you to look this up. Go to Investopedia and really look up how the pricing of mutual funds versus exchange traded funds work, because it's very fascinating. That way you can understand what's going on. Now, with that being said, there's additional books I think that are very, very helpful. And there's certain parts of it where they go through and they talk about the differences between mutual funds and ETFs. One of those books is by Robbins Wigglesworth, Trillions, which is very, very good. I read that. I love that book. The other one is The Bogle Effect by Eric Balchunas. That one specifically is dealing with Vanguard, but he goes over this type of stuff because Vanguard played a pivotal role. And everybody loves Jack Bogle. If you know anything about finance, he's probably the index fund Jesus, right? Where he championed actually putting in low cost index funds and having that as the main part of your portfolio. Now, With that being said, ETFs are interesting, right? Because they're just think of it as a grocery bag, aka a tax wrapper, and you can put a lot of things in there, right? Right now, controversy is that people want a Bitcoin ETF, right? Because they feel like they can get some of the risk out of Bitcoin. They lower the risk by putting in exchange traded funds, which will help with the volatility of it. There are a lot of things people want to eat their ETF. Now, ETF is just a wrapper. Like recently, we've seen single stock ETFs that have a significant number of leverage in it, right? But ETFs trade throughout the day just like a regular stock. They trade side by side, right? And so I love ETFs. I love mutual funds too, but ETFs are a little bit different, right? You don't have to. I remember one mutual fund I looked at, like you needed a upfront initial investment of like $5,000. I didn't have that, right? But ETFs aren't like that. You can buy fractional shares. And so that's very important. Even in the days of Robinhood like we are today, you can buy fractional shares. So you can continue to put $25, $50, $100, whatever you have, you can buy a fractional share. And if you're just getting started out, ETFs are a great way to start out. And some big things you want to look at is what the fees that you're paying. Now, ETFs tend to have lower fees, right? Again, that's part of the Vanguard effect, right? They sort of push the fees low. I mean, Fidelity, I think, even has 0 like fee ETFs. I mean, these are things that are important. Now, there's a lot of people who say that eventually mutual funds are going to convert over to all ETFs because it's better for your tax purposes. Not my lane, but that is something that is said, right? There are a lot of ETF sort of advocates. Eric Balchunas from Bloomberg is one. You can check out Verify, right? They have the ETF database, which you can look at how funds overlap, and so you don't end up with a bunch of concentrated exposures or correlated exposures, because that's very important, right? If things are correlated and they both go down, it means your portfolio goes down big time. So you need like uncorrelated return streams is what they talk about. But ETFs is something to look into versus mutual funds. There's a real good reason to think about having both, right? Or there's a real good reason to think about having one or other. It really depends on what you want to do, but I think you should look into them. Again, you got a lot of resources out there, and never forget that the U.S. government has their own resource, investor.gov. Anyway, I hope everybody's doing well. Longer video today. I'm not as tired. I hope everybody's doing well. Please continue to hit that like, subscribe button. I really appreciate your support. Follow me on Twitter at FiSurgi, FiSurgi. Talk to you later. Peace.